So while I'd say there really were no major surprises in terms of buying behavior at 1/1, the market's a little easier to predict right now because it's been an elongated hard market, slowly climbing up to probably where it was at 1/1/23, which is kind of a peak, that particular quarter at least. But now we're starting to move downhill, but it's also slow, right? It's like a slow train going down the tracks. And so it's certainly a bit easier to predict how we thought 1/1 was going to go, but it's been a pretty resilient market. There's no question about it. Reinsurance ceding commissions are up a couple of points overall, probably back to the levels of 2020, 2021. Occurrence limits are up slightly, mostly because of organic growth, and it's probably getting the time where we, as these occurrence limits grow, where we start having those discussions with our cedents if the proportional deal is the way to go, or if a cat treaty should be considered for their business. So more carriers this year have missed their 2024 pricing projections. We kind of knew that was going to happen, right, eventually. And certainly many are reducing their projections for 25 or projecting negative rates, and some reductions in subject premium are being projected as well. So these things are fine. We look back at portfolios, and I think reinsurers by and large look at that and see our clients have gotten 5 years of primary price, including double digits in many cases. So portfolios are far healthier now than maybe many of us expected they would be. And that credit to how long this hard market has certainly lasted. So back to price. As reinsurers, we do look pretty closely at the movement of price, just like a primary company does. And sometimes we look at the direction of price to a fault. We do look at adequacy, but certainly there is value in understanding how the businesses are running, certainly based on pricing. And the only thing worth pointing out here is that, at least in the primary insurance world, there are noticeable points within portfolios where sometimes the highest price projections on tough classes, tough occupancies are no longer considered opportunistic, but all of a sudden there's so much price here that it raises an eyebrow, and we are inviting an adverse selection situation. So sometimes the plus 15 and plus 20% rate increases for certain classes is a red flag. So there's been very little pushback from reinsurers to these improved terms of renewal. And I think what's pretty clear is we're all pretty comfortable where ceding companies' portfolios are at right now, particularly having gotten double-digit price increases over the last 5 or 6 years, along with, on those deals, taking higher retention. So particularly in E&S. So we're definitely seeing healthier portfolios overall. So insurance to value, ITV, always a hot topic, but certainly received heightened attention post-COVID, right? During 2020 through 2022, insurance to value increases were about plus 12, plus 13%. Obviously inflation-driven, cost of materials, cost of labor, supply chain issues that none of us had really anticipated at the time. If we fast forward, though, to 23 and parts of 24, that same average is only 2 or 2.5%. So we know inflation is certainly less than it was back then. But are we saying that with the 2 and 2.5% averages, are we adequate right now from an insurance to value perspective? So it's something to think about for sure. The slightly concerning issue that we're hearing about, and this is anecdotal, are the removal of the protections provided by margin clauses and occurrence limits of liability. And if that continues, certainly that is a downward indicator as to where the market's going. So it's probably just secondly important to price. Again, anecdotal, but worth being aware of and something we have to keep our eyes on. So there are growth opportunities in E&S property. There's plenty of new capacity in the primary markets, but a lot of what's new and available to some of the new markets is a disproportionate amount of heavy and large footprint TIV business. Definitely makes for a tough replacement, and to some degree speaks to cost of doing business with a new wholesaler and a new relationship that a new insurer is trying to make with a wholesaler. Finally, when we looked at 2025, and our objectives are the same. We can provide our treaty partners the support they expect, the support they need, whether it's ideas on optimizing their portfolios, conducting claims reviews, underwriting reviews, and certainly providing studies needed on specific classes of business, occupancies, new segments, distribution ideas, and things of that sort.